there. Our next guest says Amazon is his top mega cap pick. Gil Luria is a senior software analyst at D.A. Davidson. Has a buy rating, of course, as you might expect. Target's 235. That is the highest on the street. Hey, Gil, give me your take on the letter. I hope you watched the interview as well. Just anything stand out to you from either one of them?
Well, I think the letter goes through a very great detail about Amazon's approach, the fundamental-based approach. They call it primitives. The reason it's important at this point in time is that that's how they're approaching generative AI. They're not trying to provide a holistic solution or a singular internally built solution. They want to provide all the building blocks, from chips to models to middleware to applications, and allow their customers to take different pieces that they need in order to create the solutions that they want to use. This is a very important approach because it positions them to catch up to Microsoft Azure. Microsoft is getting all the credit for delivering AI applications and services. Amazon is getting very little credit, and in spite of the fact that AWS is the bigger business, and they're doing a lot to catch up.
So, fair to say your optimism is centered largely on what you believe is what will be the success of AWS?
Yes, absolutely. This is the most important business. It's re-accelerating this year, not just based on generative AI, which I think is a case, but also other types of tailwinds. Enterprises have stabilized in terms of trying to cut down costs. The acquisition of VMware by Broadcom has actually made the market a lot better because it's causing their customers to reconsider what they have on-premise and what they're shifting to the cloud. So they have a variety of tailwinds at the AWS business that should play out this year, while the retail business is going to do well, increase margins, but the AWS business is going to really be the driver for this year.
He also talked about cost cutting in the letter a bit, said that the company remains committed to it, said that they've challenged every closely held belief in our fulfillment network, reevaluated every part of it, and found several areas where he says we believe we can lower costs even further while also delivering faster for customers. How much room is there left to cut?
Well, there's always, if Amazon's taught us anything, is that there's always more room. They've been able to reduce the cost of fulfillment and delivery and the whole supply chain every year, and they're going to continue to do that, which extends their lead in the retail business. But the other thing that's important there is visibility into margins. In the past, Amazon hasn't been consistent in delivering margins, especially in the retail business, and the fact that they're talking about continuing cost cuts tells us that they're at the very least willing to sustain these margins, while at the same time AWS is growing at higher margins.
Finally, to your price target, given we're talking about the stock, 235 is 18.2 times calendar year 25 EBITDA numbers. Why is that an appropriate multiple in your opinion, given it certainly is at the higher end of the range at which Amazon is traded?
Well, that's right. They have an accelerating business, but I would just, to crystallize what's going on right now, I would just step back and say, if you could choose between $100 billion hardware cyclical business or $100 billion software, leading software business, which one would you pay for? Right now, NVIDIA's market cap is higher than all of Amazon. I would say that I'd rather own the big leading software business and have the retail subscription advertising business thrown in for free.